This video is the second video for the Lecture 1. I will talk about the framework for financial decision. Assume you are a manager for a corporation. Then every day you need to make multiple decisions about which investment project you are focusing on and how you collect money or financing to support your investment projects. To make such decisions, you need a good framework to guide your actions. Finance has developed a set of theories to explain how these decisions worked and how we should evaluate these decisions. These decisions are shown to be difficult, and these theories have proved to be working well. To start discussing these decisions, we introduce the finance model of the corporation. Firms need to apply real assets through operations to provide products and services. There are main two types of decisions. The first type of decisions are called investment decisions. You need to determine which real assets you are going to acquire. This type of decisions have an alternative name, the capital budgeting decision. For example, if you are the manager of Zoom Corporation and you are considering about introducing the virtual reality device to improve the online conference experience and online course experience, then you are going to ask a question: should I hire more engineers and scientists to experiment the virtual reality service? We call the evaluation of such alternative investment decisions as the investment decision. Okay, now you have determined, you have made decisions. You are going to launch the virtual reality project. Then you will face another question. You may not have sufficient money in your account to support the hiring activity and the payroll expense of new employees. So now we need to introduce the second type of financial decisions, the financing decision. So you need to raise money to acquire real assets. We call this decision as the financing decision or capital structure decision. These categories of decision are related to long-term financing. To have a better understanding of the finance model, I provide a graph here. So in this graph, we can see that the firm can be a combination of real assets or financial assets, and the manager has to consider the net working capital of the firm. You may think it is very similar as the accounting model in accounting course. Yes, the real assets is very similar to the long-term assets. For example, the 3M Corporation has plants that manufacture the face mask. We call these plant as real assets. The financial assets in the finance model is very similar to the long-term liabilities and equity in accounting model. We call it as financial assets because it is a definition for the outside investors. The outside investors evaluate whether the corporation is good investment or not. Then it provides financing for the corporation to support the real asset operation activity of the corporation. We call the difference between the current assets and the current liabilities as the net working capital. Here are some examples for the net working capital. If you are running Starbucks, the coffee machine, coffee beans, these are typical current assets for inventories. Alternative current assets can be cash. So you need to prepare enough cash to pay for the materials and expense. A typical example for current liabilities can be accounts payable toward the material suppliers. If you have a long-term relationship with some major suppliers, then you can pay the bill in 12 months. So this is typical current liabilities. For the business managers to have a smooth operation activity, it needs to consider how to have a good situation of net working capital. That is the difference between the current assets and current liabilities. Another important equation for the finance model is you need to remember that the assets will be equal to the liabilities plus the stockholders' equity. It seems like we have two lens to evaluate the corporation assets. In one side, it is real assets. It is combinations of plants and trademarks and patents. But from the outsider's view, it is like the financial assets. It needs to evaluate the value of loan, the value of bond, and the value of stock. Then it determines whether to provide financing for the corporation. Here are some typical examples of real assets. Some assets can be physical. For example, the plant manufacturing the face mask is tangible real assets. And the office buildings for Microsoft headquarters is also a typical category of tangible real assets. There are some real assets that are not physical. We call it intangible real assets. For example, 3M have some patents in the chemical ingredients. And for the Disneyland, it may have good reputation, so the trademark can be very valuable. We call the decisions related to these real assets as capital budgeting decision. Typical financial assets include bank loans, bonds, and stock. For the outside investors, first they evaluate the price of bond and the price of loan. Then they determine whether to provide the loan or bond to this corporation or not. We call these decisions related to raising funds for purchasing real assets as financing decision. Here is a graph that summarizes the relationship between capital budgeting and financing decision. Capital budgeting decisions are related to real assets. Financing decisions are related to financial assets. It evaluates whether it is valuable or not to purchasing the real assets. For the business managers, to make sure he has smooth operation activity, he also needs to have good management of short-term investment and financing. In summary, corporate finance is the financial evaluation of capital budgeting decision and financing decision. This is the main information for the second video. Thank you.